It's my pleasure to welcome back to the MedicsMoney podcast, Dennis Hall from Yellowtail Financial Planning. Hi, Dennis.
Hi, Tommy. It's always good to be here.
Yeah, so we've got zero script, and all I know about what we're talking about today is that me and Ed came on your podcast, The Century Plan. Really recommend listening to that for all doctors. And we were talking about keeping investing simple. So there's an entire industry which is making investing seem quite complicated. And I think as doctors, we've been brought up on a diet of restricted financial advisors selling us actively managed complex products and convincing us that investing is really complex. And then at the other end of the spectrum, there's what I'm saying and what you're saying. So why should we keep our investing simple?
Well, I think, we could get this down to about a 3-minute podcast if we want to, but you keep it simple because your probability of success increases, not least because the one thing you can control, or the only thing you can really control, is how much all of this stuff costs. You can't control what markets do, you can't control what governments are going to be doing, the world economy, all of those things are out of anyone's control, really. So the one thing you can control is cost. And if we buy into the idea that markets are, over time, generally going to go up, we're living in a capitalist world, and I suppose that's what it's driving about. We buy into that, we buy into the markets, we give it enough time to work, and we don't try to anticipate the things that actually we don't know anything about.
But the Sunday papers are full of people in red braces, running around the stock market, screaming buy, buy, and sell, sell, and here's the latest hot stock. And that's often what a lot of people's experience of investing is. And then someone like you or me come along and say, actually, if you just buy everything, a globally diversified index portfolio, historically speaking, and that's all we can do, say historically speaking, keep the regulators happy, you would outperform the vast majority of active investors. That is the people in red braces running around Wall Street trying to buy individual or small number of shares. And it's a bit of a mindset shift for everyone because we're just saying, buy everything, do nothing, that's it. And that's exactly what I do. I mean, I actually only have one fund as a core of my portfolio, and we can maybe drill into that a bit later. But it's kind of like the counter to what a lot of people's experience of investing is.
Yeah, and I agree with that. And it took me a long time too. So if we go back around 40 years, I suppose the beginnings of the investing world opening up to the average investor. Prior to that, you would be generally investing any spare money into with-profit savings plans. I don't know if you remember with-profit savings plans. These are fairly opaque things. You would give your money every month, your £25, £50 a month, save long-term into a savings plan. You had no idea what you were going to get at the end. You were given a bonus, a share of the profits at the end of each year, and then at the end of the term, a terminal bonus. And as a young advisor back then, I was really interested in this idea of active management. That was the new thing. People coming in and saying, well, we can decide, first of all, we can remove the opacity of all of these investments. We can give you, a real look through to see that you're invested in UK stocks, overseas stocks. You've got a bit of British Steel, a bit of this, a bit of that. Not that British Steel exists anymore, but you know what you're investing in. You think, well, I like this, and you got these grand city institutions saying, well, we're going to actively manage your money. A bit of Schroders here, or somebody else there, and the stockbrokers getting into this money. And for I would say about 20 years, I was sold on that, and I was selling that, except the returns never really matched the expectation. So I would find the simplest funds. I remember at the time a very popular fund was the Sun Life Distribution Fund, long gone. Sun Life as a brand is long gone. But this said, look, all we're going to ever do is buy 30% of our money in government stocks, 30% of our money in blue chips, and 30% in convertibles. And I'm not going to buy and sell a lot. This is the particular manager, Jim Stride. I've met him several times. Said my turnover rate is very, very low. I know what I want to buy. I know what my strategy is. Some years will do well. Some years will do less well. But actually, that simple fund, for me, outperformed all of these active strategies that I was that I'd bought into was selling. I said, well, okay, maybe I should just go for this very boring fund. So that was the start of my conversion, I suppose, to look at the simplicity. And as time has gone on, I've found, again, as I've said earlier, one of the bigger determinants is charges. So how can we reduce charges? Because that's just a guaranteed return. The industry isn't taking slice after slice after slice of your money off. You can't avoid charges altogether, and there's a price that you have to pay, but you don't have to pay some of the eye-watering charges that are out there. I know that some people in certain investment strategies are paying the best part of 3% a year. Well, the market's not going to be delivering more than about maybe 8% a year on average. And with inflation coming in at maybe 3%, you're hardly making a return. So what happened to me to get me over the line? And I've probably said this story before, but I had a client who was part of the Monetary Policy Committee, had been working in the city for many years, invited by Gordon Brown to join the Monetary Policy Committee. And I happened to be advising him on his personal pension affairs at the time. And we were having conversations about where to put the money. And he said, so I sit down to all of these regular meetings that we have to set the interest rates. And what happens is over a period of 3 days, we get leading economists come in from within government, outside agencies. They're talking to us all the time. And he said, after about 6 months of this, I begin to see a pattern emerging. Is one, they don't always agree. Two, they're saying why they said something was going to occur 6 months ago didn't quite pan out the way it was, but they're pretty certain something like this is going to happen. He said, but they don't know. Eventually you realize they don't know. And they're all very bright and intelligent people, and they're looking for very bright and complex solutions to something that could be really, really simple. His instruction to me was to go away and find me a low-cost index tracker fund that's global. And I'd already been looking at that time, and I think that was the bit that got me over the edge and convinced me that if I was doing it for one client, I had to do it for all clients. And if I was doing it for clients, I had to do it for my own money too. And so I did, and I've not looked back.
Yeah. I think it's a huge mindset shift. I like to call it evidence-based investing, right? Because as doctors, we don't just guess what treatments to give our patients. We look at the evidence and we give our patients treatments based on evidence, i.e. like what actually works. And then in investing, you can either guess, and I would call guessing and picking stocks just gambling. At the other end of the spectrum, you could hold cash, and cash historically has been a terrible investment, historically speaking, way underperformed inflation. And in the middle is a kind of acceptable risk versus kind of reward matchup. And if you look at the evidence of, historically speaking, what has worked, the vast majority of passive, low-cost global trackers outperform the active managers over the long term. And I'm talking like 5 to 10, 20-year time frame. And sure, there's a few active managers who outperform in the short term, but long term, historically, and we like the SPIVA scorecard, don't we? Because SPIVA is basically, they look at the chance of an actively managed portfolio outperforming a low-cost global do-nothing portfolio that we're fans of. And the numbers are terrible for active managers. But active managers have a great marketing department. They get their articles in the Sunday newspapers. They got their adverts in the Sunday newspapers. And also, there's quite a lot of selection bias, which lots of doctors will be familiar with. But essentially, if an active fund is not performing, they just shut it down, try and forget that it ever happened, and then focus on whatever one happens to be randomly going well that month. And it's a big mindset shift. But if you actually look at the evidence, SPIVA scorecard, if you Google that, that's a good place to start. And I think that the evidence is mounting up almost day by day, it feels, towards passive management.
It is, but getting somebody to believe that, I mean, it took me a long time. It took several years, because you're right to talk about the Sunday press. We educated or miseducated by the financial press and the fund managers to believe that active management is going to work. And as the SPIVA scorecard says, well, yes, actually, over a period of 1 or 2 years, it may work, could work, and the evidence would suggest that sometimes over a yearly period, 60% of active managers might outperform the index, but stretch that out to 3, 5, 10, and 20 years, and those numbers just keep decreasing. So, what is it that drives us as humans to complexity? And there is a bias to complexity. Part of it can be education. If we're already highly educated, and doctors are, and you look for complexity, almost as to use our brains and say, well, I'm thinking about this and I want to think about it. And there has to be a complex solution to this. It can't be that easy. Surely it can't be that easy that all I'm going to do is buy the market. There's something around social status too, and the amount of money we've got. If I've got a lot of money, why should I be having just a single fund or two? Surely I can afford to pay somebody to beat the market. Well, as we've seen, you can afford to pay, but they can't consistently beat the market. So we are attracted to complex solutions, but in all other aspects of our life, we can see where that doesn't pan out. I mean, I don't know. I mean, the household appliances that I've got, the computers I've got that are highly complicated and have cost me more money as a result. If I look at our washing machine at home, I just use one program, but it's got about 35 of them, which is I just want that one. But I've paid for all the rest. If I look at my computer, I use it for, I use a very simple suite of Microsoft products, but other people can use Google. But everything else my computer does, it's just a glorified typewriter for me. Everything we look at, we want to buy complexity, and complexity leads to cost. The most expensive watch in the world, reputedly $10 million, they only made one by Vacheron Constantin, has 57 different functions. And the beauty is everything that a watch does is called a complication. Hours, minutes, seconds, calendars, everything is called a complication. And it took them 8 years to design and build this watch. They've only built one. $10 million for something that you could get on your arm and say, all I want to do this is tell the time. I mean, I've got a fairly complicated watch on my arm right now. I can look through it and see all the things moving, but I could buy a £10 watch with a battery in it that will do exactly the same job. It's telling me the time.
Yeah, I think it might be a Bogle quote, founder of Vanguard, is in investing, you get what you don't pay for, right? So basically what he's saying there is that active funds are more expensive than passive funds. And that extra that you pay for an active fund essentially is, as you said, hurting your returns. And yeah, I think the investment industry, they need active funds because that's how they thrive. And they need these promotional pieces in the Sunday papers. And also, I think like, if you say to someone, put £200 a month into a globally diversified index tracker, if you'd done that 30 years ago, by now you would be a millionaire, and you would have had to do nothing. It's like, what? Like, nah, must be a scam. Sounds too easy. I must need to do some buying and selling and some trading. And I probably I need about like 20, 30 funds. But actually, statistically speaking, that is what would have happened. So I think, yeah, it's just overcomplicating things unnecessarily. I also think so I've been investing now for 12 years. And even in that time frame, I think investing has become way more accessible. And some ways that's good, and some ways that's bad. But back in the day, it was kind of hard to manage your own portfolio, and there wasn't really many platforms around that could allow you to manage it. And now there's loads of platforms that can help you to manage it. And I guess where this goes is, if investing is so simple, why should I not just log on to a platform and buy a fund? And why do I need you, Dennis? Because I see this all the time, and it's kind of like the same question about like, oh, medicine's easy. Why do we need doctors? But if it's so easy, why do I need you?
Well, I think part of that is getting people to understand that it can be that easy. I think in the role that I have, the investment question, which used to be the major question, people come in and say, I've got this money, and you'd have long conversations and you'd present your investment strategy in a pitch. That's the last thing. It's a tiny part of, this is how my philosophy about investing. You could do it yourself if you wanted to, as you've alluded to, and you could. The difficulty is getting people to understand that in the first part. And two is, where should I put it? There is a lot of complexity. We've got huge complexity around pensions, our tax. The tax regime in the UK is among the most complicated in the world. I don't know anyone. I mean, you take your lifetime to read through all of the tax legislation that we have. It's incredibly complicated. So you've got to get around that. And I think people are also driven to, If the investing bit is easy, then the planning bit has probably got to be harder in their mind. I want to avoid inheritance tax. I want to do this scheme. I don't want to pay so much income tax. I want to do that scheme. And so, in a way, I'm trying to talk people out of trying to add complexity somewhere else and create some simplicity.
Definitely. I see, like, in some ways, financial advisor like a personal trainer, right? I know what I need to do to get fit, right? And I know how much I should do it. And I could probably do it myself, right? But if I've got a personal trainer, I've got accountability there. They're overseeing it, making sure I'm doing things right. I'm going to make gains faster, and they tailor things to my individual circumstances. But looping back to evidence, there's the Vanguard Advisor Alpha study, right? Which is, if you're an investing geek, you should probably look at this. But basically, Vanguard have access to both sides of the coin because they've got people that invest themselves and they've got people that invest via financial advisors. And they looked at the returns of the people that do it themselves versus the people that used a financial advisor. And overall, the people that used a financial advisor outperformed by 3%. And I was like, 3%, that's huge, like over a time frame. And a lot of people must think, oh, that's because the financial advisors had access to some special information or picked some special stocks or did something special. But actually, what Vanguard concluded was the two reasons that clients that had an advisor did better than those that didn't was, one, as you said, tax complexity. If you've got simple tax affairs, no worries, but probably lots of us don't. And the second reason, which is the most interesting reason, not stock picking, not secret sauce or any kind of magical skills. It was just behavior management, specifically behavior management in a downturn. Because when the market's going up, right, your job as a financial advisor is ridiculously easy. People are making money and it's just all glorious. But actually, investor behavior in a downturn, and remember, historically speaking, downturns do happen. The stock market goes up mostly over time, but it definitely goes down, goes up 75%, down 25%, overall up. Investor behavior in a downturn, that is when I start getting questions from my mates like, oh, should I convert to cash? I actually made a YouTube video about this at the start of last year because there was a war on, or might have been two wars on. Inflation was rampant. You could get 6% in the bank. And people were asking me, oh, are you selling all your stocks and shares and going back to cash? And I was like, no, I'm not. This is what I'm doing. Nothing, of course. And then I made a follow-up video, which was pretty smug because I did about 15% last year. But my point is, I just did nothing, and doing nothing and ignoring all that noise, ignoring inflation, and there's a recession coming and there's a war or two on, which is just terrible. I just ignored all that, kept buying investments automatically every single month. And at the end of that supposedly terrible year for the stock market, I was up 15%. And if I'd been in cash that time, I'd have had a right shocker. So doing nothing is actually quite hard. And actually, it sounds weird, but Vanguard's Advisor Alpha advisors help you to essentially do nothing, which sounds weird, but it's hard.
Paying somebody to tell you to not take action because it's counterintuitive. But there was a study done. We had the financial crisis 2008, and you're expecting active managers to have pulled out. All the warning signs were there. We could see what was happening in the American mortgage economy. We could see all of this stuff, and it's unwinding. Active managers were too late to pull out. And in some respects, within unit trust, there are restrictions on, you can't just go to 100% cash anyway. So what are you paying for? A little bit of movement or stock picking. But active managers were too late to react to the downturn. When they finally did try and position their portfolios for that, when the upswing came, and it came reasonably quickly and then sustained for quite some time, managers themselves were too cautious and got it back in too late. So they missed they missed a lot of the downswing and they missed the first part of the upswing. They should have just stayed in there. It would have saved a lot of money. It would have saved probably a lot of heartache too.
Yeah, I think a big realization, sounds like what you had with your economist client, is that once you realize no one can predict the future, that I can't, you can't, Dennis, but even your person who sits on the IMF committee at the Bank of England can't predict the future. Once you realize no one can predict the future, the kind of only logical conclusion from that is to buy a little bit of everything, diversification in a global index, keep topping it up as regularly as you can. And historically speaking, past performance does not reflect future returns or whatever we're going to have to say to keep the regulators happy. But historically speaking, you would have made a ton of money and you would have outperformed the vast majority of active managers. And that's not even the worst thing about active management, is that You can look back retrospectively and go, oh, manager X was an amazing manager. But what you needed to do is like rewind 50 years, be wandering around Omaha in America and be like, oh, there's this young upstart, Warren Buffett. No one's ever heard of him. He's got no investing track record, but he is the active manager that I am going to choose out of millions of others. I'm going to put all my money with him. And then 50 years later, you'd be feeling pretty smug. But there's a lot of people that didn't get in that early. So picking an active manager retrospectively, easy, but prospectively, which is what you have to do in reality, is basically really, really hard. Like, how do you know who's going to be good? You don't. No one knows.
And if you read several books about Warren Buffett, but Snowball was a book that I read, and it talks about his early years as an investment manager. All of those people that invested with him early on, he had some good years and bad years, but they all bailed when he had a bad year, and they didn't get back in. And as you say, you would have to stay with him the long term to get that run. We've seen exactly the same in the UK. Anthony Bolton used to run the Special Situations Fund for Fidelity. If you'd been with him for the 25-year tenure he had with that fund, and you'd have had to know it at outset, he would have produced for you about 19.5% a year, which is very good, but he's investing in special situations, small stocks, value stocks. So if you could have had index funds at that time that invested in small stocks and value stocks, you would have got a very similar return, about 19.2%. I did some research about this. So yeah, there's a tiny bit of outperformance, but he was the only manager. And as you say, you would have had to known ahead of time, and you would have had to live through all of his downturns. And he had some pretty horrendous downswings when most people would bail.
Yeah. Are we going to talk about quite an infamous, like recent example of Neil Woodford?
Well, we could. I mean, if he just stuck to his knitting, I mean, it was okay. When we see these active managers, I think we compare them to the wrong index for a start. So we think, well, against the market, he's done well. But if you have to look at what their underlying investments are, they're taking a position in a particular area that may or may not work out. And for him, it worked out well. At one point, I think he was well into banking stocks when banking did well. Bolton, when he decided he wanted to get out of special situations and lured into China, it was a disaster. He didn't have any expertise in that market, and he picked wrongly. So, he might be good in one area. You don't know how much is luck and how much is skill. You can't identify that. And there are so many sort of indices out there that try and determine whether there's some manager alpha. I mean, are they outperforming or is it beta? It's just market returns. But you still won't know.
Yeah. Yeah, and just to sort of fill in the blanks. So Neil Woodford, I think he managed an Invesco fund for a long, long time, and it outperformed for a number of years. And he was the darling of the UK. I think often referred to as UK's answer to Warren Buffett. Things were going well right up until they weren't going well. When he branched out into a new fund, it went disastrous, and lots of people actually lost their money. Which kind of goes to my point that anybody can outperform the market for a short period of time. But outperforming it for 20 or more years, which is what your kind of investment time frame is really, really hard.
Yeah, and I think he felt he was being constrained by Invesco, plus he wanted a bigger slice of the pie. In having other people's money and earning on it is a very easy way to get rich. Well, it is. It is. And you should be paying people like me in the city as little as possible. I mean, we're not going to do this work for free. But you should pay where you're getting value and where you can get some real added value. And if that's the added value is, as we talked about earlier, helping you get to a solution that is simpler than you might have achieved on your own, or it's something that you can stick to. I mean, you mentioned exercise regimes, and I know whenever I've tried to set out an exercise regime, it becomes complicated. And I'm going to do this, and on that day I'm going to do upper body. That day I'm going to do lower body. I've got to get a variety of exercises in there, and I'm going to do some cardio. And the more complicated you make it, and the more pressure you put on yourself, the less likely you are to follow through. Whereas the simplest thing for getting out there and getting fit, people say, is to put a pair of shorts out next to your bed in the morning. You wake up, you see, that's the first thing I'm going to do is get in my shorts and get out of the door. Just make it that easy. What are the tools I have to put in place to make it really easy for me to get fit, for example? And it's the same with investing. I see so many people that have come with really complex portfolios that they might have built themselves, but they just run out of time, energy, interest, or whatever, because real life takes over.
Yeah, and often in those funds, when people have built their own portfolios, they've kind of got on board with the whole. I call them active passive investors, right? Because they kind of get what we're saying. Okay, passive is good, and then they buy one global fund, and they're like, awesome. And then they go on Reddit or Facebook, and someone else says, "No, I've got this fund." They're like, "Oh, well, I'll just buy that fund as well." Two funds, and then they're like, "I need to get some bonds. I get some bonds, and add that in, add that in." And actually, when you look at their portfolio, they've got 20 funds. They basically all just completely overlap each other. They've never rebalanced it. And they've just been flitting from one popular fund to another popular fund. And if you do that, funds aren't popular when they're cheap, and funds are popular when they're expensive. And if you buy things when they're expensive, that's not good. It's like that when there's a sale on at the shoe shop, okay, and 20% off sale, there's a queue out the door for people looking to buy. But when there's a 20% off sale in the stock market, which historically happens very, very often, there's never a queue. And everyone's
Actually, they
selling.
want to be
And
the
I'm like,
seller.
yeah. And if you're at the start, if your investing timeline is more than right now, then when there's a sale on, for me, if there's a big sale on in the stock market, it's just like, oh, this is amazing. I'm buying at a discount. I'm buying the same amount of stock for 20 or 30% less. And like I said, when it's a shoe shop, everyone wants to buy, but when it's a stock market, everyone panics and, I don't know, sells or something wild.
Yeah, human nature. Again, it's just all down to human nature. The more we can understand that, and I think as an advisor, my role is to understand what drives humans more than it is to understand what drives markets, because I'm not going to be able to understand that in the same way. We've, as humans, we've been observing the weather for millennia, and we still can't work out whether it's going to rain on a particular spot on a particular day. We can have a reasonable idea, but the amount of observation of things that will impact the weather that we've been building up over 3,000 years, and pretty often, well, I was listening to Radio 4 yesterday, and they were talking about, it's not about the weather, they're talking about the ability to predict earthquakes and things. And nature, they said cows can predict this thing before it happens. You just watch what happens to cows. If they think there's something happened, small tremors, they get nervous, they get twitchy, they can sense something in the air. Things are changing. And they're talking about that with weather. These are unsophisticated creatures that just listen to the nature, what's around them. And we have got sensors all around the globe to look at clouds, to look at heat spots, to look at everything. We've got satellites, we're throwing things in the air, and we still can't predict the weather properly. What hope
Yeah.
have you got to predict market returns when you're dealing with so many competing drivers in the markets? People have got different investing strategies. They've got software in place to drive market trades. You've got emotion involved. You've got governments that on a turn of a sixpence can do something. You're not going to be able to do it.
Yeah, and I guess the whole concept behind passive investing as well is that once you realize no one can predict the future, the other realization is that actually you don't need to predict the future, because historically speaking, global capitalism, has returned 6 to 8% inflation adjusted returns for the last 100, 150 years. And so that's like the average. And when people say to me, "Oh, what's your goal, like your target return of investing?" I'm like, "Oh, just targeting average returns." You're like, "Average doesn't sound very good. I want exceptional returns." I'm like, "No, just average returns, because you can't predict the future. Average returns, historically speaking, is gonna, absolutely smash all of my financial goals. And if I want to target above average returns, like beating the market, it's A, incredibly hard to do, and B, I just don't need to take that risk, because just doing nothing by a global index fund, historically speaking, has done extremely well."
It has. There's a great book that, I'm not sure anyone of your listeners are going to buy it, but Triumph of the Optimists. Elroy Dimpson, I think, one of the professors, the lead professors, London School of Economics at the time, looked at market returns over about 100 years, 101 years of just investing in equities rather than, trying to get this equity bond split. And it's called Triumph of the Optimists. Is that just simply investing in the index in equities versus trying to do anything else gives you what you need every time in every market. So it's a great book. You also mentioned the difficulty of outperforming the markets. I've just forgotten the guy's name. There was another book by a hedge fund manager who'd been trying to run a hedge fund. And eventually he concluded, I can't beat the market consistently and I'm giving up. Brightest of the bright, these people. Long-term
Yep.
capital management, 1998, brightest of the bright people coming up with a hedge fund, the most complicated hedge fund, which nearly put the whole world in financial meltdown and had to be bailed out.
Yeah, predicting the future is tricky. Okay, so someone's listening to this. Maybe they've got a portfolio, maybe they've got an advisor, maybe they don't. Like, what kind of tips or whatever can we give them? Like, what should they look at? What should they think about?
Well, I think rather than just rushing out there and trying to find a global index fund and throwing all your money in there, take a step back and say, what am I trying to achieve? The money is a vehicle to get there, but what am I trying to achieve? And try and set out some kind of timeline about how much money is available to me, what's my income and expenditure at the moment, what's it likely to be in the future. Ultimately, we're trying to create a nest egg that we can survive, and not just survive, thrive on in those years when we're no longer working. So we're no longer trading time for money. We've hopefully built up a huge sum of money to support us through our lifetime. What does that look like? Because I don't think, we look at the statistics. Most people in work don't know how much is in their pension. They don't know how much they're going to retire on. They don't know what their state pension is, for example, or when they're going to get it for a lot of people, because the state pension age has been moving. So just begin to look at some structure, create a financial plan or a simple cash flow model. And that's where people like me can help. Because when you've got a model that says, in X years' time, I need a certain amount of money, whether that's 500,000, a million, 2 million, everyone's different. Whatever that sum of money is, adjusted for inflation, that's where I need to get to. Here's where I am today. How am I going to get there? And what's the best tax strategy to follow? Should I use pensions? Should I use ISA? In what combination? The investment then is the easy bit. Then you say, well, I've got an idea where all my money needs to go, how much of my annual money I need not to spend and just hang that, hold that back for the future. The investment strategy, as I say, is the easy bit. The hard work is the cash flow modeling. People don't want to do it. They don't like planning. So they'll just dive straight and say, well, I'm just going to save this amount of money without knowing whether it's enough.
Yeah. And I think like when people if you look in our YouTube comments, there's always a few people saying, what should I buy? And what you're saying is what to buy is literally the last question. Before that, you got to do everything that you just talked about. How much do you need? What else are you going to get? What else have you got? What's the best tax strategy? What is your belief about active versus passive? Because historically, the best portfolio for you is the one that you can stick with long term. If you're chopping and changing all the time in your portfolio, that's not a good sign, in my opinion, and not going to lead to success. So yeah, the last question should be what to buy, not the first question. I like that.
Yeah, and it is. And I find with me, the clients I've had who are most successful financially are those that have done that planning work. And they sit down with me, usually annually, to do some forward planning. We don't have, I think other advisors call them annual review meetings. Well, I can't change what's happened, how much has it made? It doesn't really matter. The forward planning meeting, sit down, what do we need to do? What's changed in your life? What's likely to have happened? And I find that if you ask intelligent questions of people that they may not have consciously asked themselves, you can drop these questions in and say, you might not know the answer today, but in a year's time or 6 months' time, they come back and say, I've been giving this some thought, and actually things we thought were important to us are less important. So can we adjust the plan going forward? Maybe we don't need quite as much money as we thought, because actually our lives look like this. And maybe sometimes if we want to help our children on the property ladder, can we afford to do that without impacting on our quality of life? So I think it's the planning around the money, and just leave the investment machine to keep working in the background.
Yeah, definitely. Awesome. Right. We need to get someone like, if you're a fan of active management, or we just keep agreeing with each other, Dennis. It's way better when we have an opposing point of view. So I'm trying to find some active management fans to come on. They're kind of hard to find, but I'm sure they're out there.
There are some, and it would be wrong to say that active managers, it can't work. It can, but it's almost a full-time job. And I mean, I've seen some active managers who follow a strategy, a bit like Buffett, who put all their own money in, and I would call them high conviction managers. So they're not essentially tracking the market. And I talk to them when they go through significant downturns. I'm not going to mention any specific funds, but I've had conversations with them in the past and still do. If they're prepared to take those risks and they will live and stick to their own philosophy, I have found that that's worked for them. Again, they've got to run it over the 20 years. It's when you're a manager working for somebody else, and if you'd have those years of underperformance, they boot you out. You alluded to that earlier. So you find an awful lot of fund managers that have got the school fees to pay and a mortgage to pay are just going to toe the party line or closet trackers in a way.
Yeah, they just end up index hugging. By that we mean they try and just not lose out to the benchmark of an index, but then you add in the fees of like 1.5%, and they will lose out. So index huggers, active managers that are index huggers. Yeah, I hate index huggers.
Yeah, but I do have a sense of admiration for conviction managers who stick to their philosophy through thick and thin. And if they do that, they will have periods of top quartile performance and periods of bottom quartile performance. But over time, I think they get there. But most consumers never live with those managers through all of those cycles. So they will try and time. And if you're that kind of person, don't bother.
Yeah.
You either have philosophy or you don't.
I guess we should also mention that like some of the largest financial organizations that target doctors are restricted advisors who mainly sell active funds. That is like kryptonite to me.
Yeah.
But they're out there. So yeah, I mean, if you've got an advisor, have a look. Are they restricted? Are you using a lot of active funds? What fees are you paying? What is the investment philosophy behind your investments? Because we have to say that some of the largest ones in the UK are restricted financial advisors. We know why that's not ideal. That mainly sell actively managed funds, which historically have underperformed massively. On that bombshell, we should probably wrap it up. Dennis, that was an awesome discussion. I hope that listeners found it useful. I know that they do. Just these kind of it is a behind closed door discussion. I don't know why. We should have it out in the open more often.
Well, I was just going to say, could you make it too simple? There was just one final point I had to make, is that keep it simple is often attributed as something that Einstein said, and nobody can actually ever prove what he did. I think, but what he says, keep it as simple but no simpler. And whenever people talk to me about simple, there's a story about the space race of the 1960s, when apparently NASA had spent so many millions of dollars trying to create a pen that would write in space in zero gravity. And so they talk about NASA spending $1 million creating a zero gravity pen that would allow them to write in space. And the Russians, who were also on the space program, used a pencil. And it sounds like a great story, and it's completely untrue. There is a space pencil. It was developed privately. It cost about $1 million to create. It's zero gravity. The ink cartridges are under pressure. The problem with the pencil, being the simple solution, is that lead breaks and it flakes. And so in zero gravity, you've got carbon dust and lead flaking floating around the cabin, getting into machinery that could ultimately cause fires and crashes in space. So you can be too simple, as simple as possible, to make it work. And I think that's where the planning comes in, to think about all the things that potentially could go wrong as well as could go right.
Yeah, awesome. Brilliant, Dennis. Century Plan podcast. Love your podcast. I know you've got another series coming out soon, so that's cool. Where else can we get hold of you?
We've got a website, yellowtail.co.uk. Yeah, the podcast keeps us busy. We don't send out much in the way of newsletters, but that's where you can find out about us.
Brilliant. Cheers, Dennis.
Cheers. Thanks, Tommy. Good talk.